Good afternoon in Singapore or wherever you may be in the world, and thank you for joining this session. My name is Sarah Williamson, and I'm Chief Executive Officer of FCLTGlobal. We are a nonprofit organization whose mission is to focus capital on the long term to support a sustainable and prosperous economy. For the next half hour or so, we'll discuss the issue of resilience and how to navigate in a world of transition. In the past, companies were rewarded for perceived efficiencies and lean balance sheets, tight supply chains, just-in-time delivery, and returning capital to shareholders to the fullest extent possible. Now, companies are facing disruptions across many fronts, including inflation, geopolitics, and sustainability imperatives. As a result, they're trying to build resilience into their operations and their balance sheets. The challenge is that many diversified investors see that resilience as bloat, and activists can see opportunities to come in and cut. Furthermore, boards may look for the short-term returns that efficiencies can bring. The key question for companies is how they can build long-term resilience into their businesses to manage the big shifts we're seeing in the environment while also staying agile and lean. And for investors, the key question is how they can evaluate the company's strategies and put a value on that resilience. So today, we're joined by business leaders from around the world who will be able to shed some light on how they and their organizations are viewing the way forward on these issues. Liew is Chief Investment Officer, Fixed Income at our host, GIC. She's been with GIC since 1998 and oversees the fixed income portfolio, which includes investments in macro, credit, securitized products, convertibles, and cross-asset systematic investing. C.S. Venkatakrishnan is the Group Chief Executive of Barclays. Prior to his appointment last year, Venkat was head of global markets and co-president of Barclays Bank PLC from October 2020, and Group Chief Risk Officer from 2016 to 2020. And George Walker is Chairman and Chief Executive Officer of Neuberger Berman. Prior to Neuberger Berman reemerging as an independent firm in 2009, George was global head of the investment management division at Neuberger Berman's former corporate parent, Lehman Brothers. Previously, George spent 14 years at Goldman Sachs. So, Subi, Venkat, George, thank you all very much for joining us in this discussion today. So Sumi, let me start with you. GIC has done a lot of thinking in this area in the build-up to the GIC Insights. How prevalent is the trend for companies to be resilient to disruptions while also running efficient businesses? Do you expect that trend to continue?
Absolutely. This is a trend which is here to stay. Today, companies are facing a lot of disruptions across many fronts. For example, first, the pandemic, which really brings about almost a sudden stop in the economy, at least in the very beginning, the mobility restrictions and the disruption in both the demand and the supply chains. And secondly, a shifting and highly uncertain macroeconomic regime where we are seeing higher inflation and lower growth, which is historically a very challenging setup for businesses and investors. Third, increase in geopolitical fragmentation, both in terms of trade tension, as well as even physical war. And fourth, rapid technological change, which can easily disrupt incumbent business models. And finally, this rising pressure to transition to more sustainable practices, not just for climate change, but also increasingly the focus on social aspects, inclusive growth, DE&I, etc. So as a result, firms are really trying to build resilience and the ability to withstand or adapt to disruption into their operations and their balance sheet while ensuring that businesses are still running efficiently and remain agile. The optimization function is no longer just about efficiency and costs, but also resiliency and sustainability. In some ways, these really are business imperatives for survival.
Right. So Venkat, let me turn this to you. How do you see this issue in the financial services arena? Clearly, resilience is extremely important, both to financial institutions and, of course, to their regulators.
Absolutely right, Sarah. First of all, thank you for having me. I'm very, very grateful to the GIC for inviting me to be part of this discussion. As a long-term investor, the GIC over many, many decades has invested in a lot of companies, and I think they've seen the value of resilience. And in the financial industry, it has always been important, but I think the focus has changed. So what the financial crisis had a lot of regulators and banks themselves and industry participants focusing on was the financial resiliency of the individual institutions. So the imposition of stress tests and capital requirements were all to make sure that they had enough capital and enough liquidity to withstand a downturn. And I think the banking system, across the world, but certainly in the developed world, has made a tremendous amount of progress in that. And as we saw during COVID, and we've even seen in the last year or so, the banking system has stood up fairly well to the various shocks that have been in the system. The focus has changed in the last few years from financial resiliency. Not that that's not important, it's very important, but we've done a lot of work shoring that up. But it's changed from financial resiliency to operational resiliency. And that operational resiliency has come, that focus has come in because of two important threats that have manifested themselves. One, of course, is even before the Russia-Ukraine war, but especially after that, a lot of worry about cyber threats. So as much of the banking system is now electronic, as more and more people transact electronically, I mean, for all the major banks, including Barclays, the biggest bank branch is the phone. And over 90% of our consumer transactions, our retail transactions, are done electronically. That cyber resiliency has become very important. And COVID in its own way tested operational resiliency because many of us have over the last number of decades disaggregated our operations, where we tend, for instance, to have a large amount of our basic businesses processes, financial processes, even risk processes run out of India and other countries around the world, not in the sort of main headquarters in London or New York. And we all had to test our electronic connectivity, our backup centers through that. So I think resiliency is extremely important for banks. I think the shift is taking place from a focus on financial to operational. They're both important. The second one has had less attention until now.
Yeah, that's a really important point that we've shifted. Now, George, let me come to you. You as you think about this as an investor, what role do you see investors playing in this trend? Because sometimes they could be supportive of resilience at the company level, because of course they want companies to do well, but they're also diversified. And so they often think about resilience more at the portfolio level, using portfolio tools in their construction. So what's the investor perspective looking at the companies from your side?
I think both of those are true, Sarah. So as investors, we are trying to build resilient portfolios, but you still need the building blocks. If you're building a credit portfolio or an equity portfolio, we need the underlying companies, themselves to be resilient. And so for us, that entails real conversations with management teams and boards, putting resilience on the agenda and talking about it, and trying, frankly, to differentiate between those teams and those firms that are well prepared versus those perhaps who have made ill-timed macro bets. So is a firm investing, in fact, to diversify its supply chain such that it is better prepared, or have they simply built too much inventory, planning for an environment that has fundamentally changed? So it's really about engagement with management teams and having, frankly, a transparent dialogue. And I think it is increasingly important to us as investors that the firms that we're investing in are resilient and are agile, frankly.
And making that determination is so challenging. Venkat, let me come back to you for a little bit, because the sometimes you can have an activist come in and say, what a company may see as resilience or, fortifications, they may see as excess cash. How do you think about that tension between building that resilience, but not wanting to have such a good balance sheet that somebody comes in and tries to take it away?
Yeah. So I think that's a very, very real issue. And I think, activist investors, we had one in Barclays for a few years. And you tend to think in sort of large, well-regulated banks, it's hard to get activists, but you do get them. And we had one, and they focused on business model and return of capital. And the real issue comes to that return of capital question. Because let's assume you can defend the business model. On the return of capital, when you think about it, most people have basically an objective investing in the business versus returning to shareholders. For banks, we have the added pleasure of keeping capital aside for a rainy day because of changing economic conditions. So the tension will come right there. And I think it's really incumbent upon companies to identify what kind of investment they need to make for resilience and why. It's possible investors, general investors or activists don't buy that argument. But I think it's an argument that has to be made much more today and in a very specific way, rather than just sort of investing for competitiveness, which is important too. But I think this is a language we've got to start acquiring.
And George, how do you and your teams make that determination? Are they investing for resilience, or are they, padding? How do you kind of try to figure that out?
It's hard, but that's exactly the right question. And you do it by engaging with management teams. I think you recognize, frankly, that this is not a one-time game. This is a repeated game. And so, we build scoreboards for management teams and boards and see how they have done over time and through cycles in pursuing things like operational excellence and capital deployment. I think governance matters too. Oftentimes, when we see poor capital allocation decisions from firms that frankly have poor governance, so it's we can point to examples. We challenged a firm recently in Japan that has 1.4 times sales in cash and 90% of their market cap in cash. That we thought was extreme, to state the obvious. Others we've challenged on the opposite side, which have been insufficiently resilient. So it's like everything else in this world. It takes real work, it takes insight, it takes pattern recognition, it takes dialogue, and it takes transparency and engagement, precisely as Venkat articulated.
Yeah, I like adding that governance to the operating model, the balance sheet. That makes a lot of sense. So Subi, from your perspective as a long-term investor, how do you think about this? When is a company's capital allocation an indicator of hopefully future long-term outperformance versus excessive conservatism, like it sounds like George's example just was?
Yeah, it's interesting that as you extend your horizon, a lot of the so-called short-term trade-offs, tension is actually a lot more aligned than you think, especially when you lengthen that horizon. So for us, we think that the ability for companies to implement sort of resilient strategies, sometimes even at the expense of short-term performance, can be actually a critical signal to think about how best they'll perform over the long run. Because if you think about it, businesses that are able to consistently demonstrate their ability to increase resilience over different kinds of outcome really should increase our confidence, over their ability to thrive in different environment in the future. So when we think about capital allocation, that is indeed the key here. It's not just about short-term performance, short-term goals and results, but really the emphasis is on understanding how companies think about their long-term goals, which should be demonstrated and evaluated on the capital allocation decisions, how strategic they are on various issues, and how they incorporate, for example, scenario stress tests or scenario planning as part of that planning process to navigate very different environment and very uncertain and volatile environment. Now, on the latter, we really like companies that can introduce the right processes and mechanisms to navigate disruptions, which is, we think, critical for them to sustain long-term enterprise value and performance. And we believe that, and you have said, we have said this many times, companies which are able to demonstrate that resilience and are prepared for a range of potential outcomes will be able to create more value over the long term. This is almost like, as a long-term investor, part of that core investment belief and philosophy. And we see that validated really just as recently as the COVID crisis, as well as the Russian-Ukraine conflict, where we can see really the winners and losers, or companies that can do better than the others just by looking at the way they deal with different crises. And I like to take another example, which is sustainability. And we would like to see companies really taking specific and concrete actions towards more sustainable practices. For example, allocating a significant part of their budget and capital to accelerating the transition is really a strong indicator of their ability to deal with ESG risks, to deal with the fact that the regulatory environment is changing quite rapidly, especially on climate change issues, and frankly, a vast, changing consumer preferences as well. So as investors, we really like to evaluate whether or not they have credible and viable transition plans in place. And these are really key indicators for us to think about how well they will navigate the future. And based on our experience really engaging with quite a few companies now, we found that companies which have integrated the sustainability plans more closely into their core business plans tend to be more serious about sustainability and more likely to deliver on that long-term resilience. Which ESG issues are material to the business, in what ways, what type of sustainability risks and opportunities they're grappling with, and how they plan to address each of these risks, and so on.
So you've raised a couple of really important issues I'd like to turn to and build on. Maybe Venkat, will come to you. You've talked both about geopolitics and sustainability. So let's move to each of those in turn. So Venkat, in terms of geopolitics, I think that the consensus is we've got some turbulent times ahead. We're in some. We expect them to continue. So do you think of geopolitics and what's happening in the world today as a reason to build resilience or a hindrance in achieving that goal? How do you react to Sumi's points on geopolitics?
So I think Sumi has raised two excellent points which are affecting the way we view this debate. One is geopolitics, and the second is the importance of sustainability. And by the way, I think the two of them are linked. So at a broad level, I think if you look over 30 to 60 years of industry company performance, the resilient companies are the ones that have always come out in the long run better. They have survived industry shifts in technology. They have survived in the banks, financial crises. And so even in the short term, if companies are not rewarded, in the long term, they tend to be rewarded for this. When you come to geopolitics, I think it's a short-term hindrance, but a long-term push forward towards resilience. It's a reason to build resilience in the long term. And if I can come to the sustainability point, the simplest example of it is if you take Russia, Ukraine, and immediately, of course, energy supplies in various countries are affected. So they're turning more to oil, they're turning more to coal or gas, they have to. But people are already using the language to say that if they have renewable resources fueling their energy, actually it builds them resilience and self-reliance, because it's your sun that's powering your solar farms, it's your wind that's powering your wind farms, and your hydro and your nuclear if you include those. So that is actually a resilient electricity network for individual countries. So I think the two come together. And I think geopolitics actually, while it looks in the short term to be a hindrance, in the long term, it's actually going to be a motivating factor.
All right, George, let me come for your perspective. Two very big topics: geopolitics, sustainability, and the interplay between the two. Do you think, given current economic tensions, people are going to start tapping the brakes on sustainability, or is this time to really accelerate those efforts in the face of all the things that are going on around the world?
I just had an important Nordic investor explain to me that ESG now means energy, security, and guns. But notwithstanding that, I don't frankly see companies or tapping the brakes on these important issues. I think this is a journey. It is not going to be a straight path. This is not about a simple 7% reduction or improvement each year. I think we're starting to see increasingly supportive policy choices, and so while there will be 27 bumps in the road along this path, we really don't see investors or companies globally pulling back from their long-term commitments and their long-term orientation. If anything, we see folks trying to figure out how to realign their business models and incorporate sustainability into their operations, precisely as Sumi articulated.
And geopolitics, do you have any, one of the challenges that companies, of course, have, that many companies realized in the wake of Russia's invasion of Ukraine, is back to this point about what is their long-term strategy. Some people maybe had a very strong long-term strategy for why they were in Russia or why they weren't going to be in Russia. Some other people sort of woke up and found themselves there. Is there, is there a way to help think about, are you encouraging companies to think about their geopolitical strategy, perhaps more than a year or so ago?
Sure, of course, and how firms are thinking about China, for example, when it appears that we're going to have increasingly contentious relationship with China. It's going to be bumpy, likely over the course of the next few years, and so understanding, I think, in a scenario-based analysis, as Sumi articulated, if then how companies are prepared to react in various scenarios. So I think, unfortunately, these are things that are. It's difficult to predict precisely which regime we're going to find ourselves in. What we need to do is to build firms and frankly, portfolios that are going to be more resilient and better prepared to deal with disruptions. I don't know exactly what disruptions we'll face, but the Russia-Ukraine horrible conflict was I think a good wake-up call for many of us that these challenges will continue to appear and are ones that companies need to prepare for and to build more resilient firms. And frankly, again, I can't emphasize enough, at the same time, more agile firms. These are not mutually exclusive. These are not mutually exclusive topics. They need to be doing both well.
Yes, I think that is the task for people who are running companies, which of course is a challenging one. But whether it's COVID or the Russian invasion of Ukraine, or we've had a number of examples of disruptions in recent years. So scenario testing and sort of thinking about the things that we didn't think would happen is very important. So Sumi, let me come back to you a little bit. We've all been taught from an early age about risk and return in a portfolio, and we've thought a lot about those in terms of portfolio construction. We've been thinking a lot about how do you incorporate resilience as sort of a third angle, given that risk, at least in the financial world that we all live in, is often measured in terms of very short-term risks. It's volatility often over very short-term periods of time. So how do you think about baking resilience into that portfolio construction mindset, and how do long-term investors balance that risk return resilience when actually constructing portfolios?
Yeah, those are very important questions. So I think we have to start by asking ourselves, what is exactly our client's risk tolerance? What is our own risk tolerance? That has to be the starting point. And then from there, really moving on to emphasize that as a long-term investor, it's important that we do our homework, we gain that conviction, we understand the valuation anchor, because in this world, frankly, the market is just so volatile that you need to have some sort of anchor to navigate a very volatile market. And I think that will serve us well over the long run. But I think, like what you said, it's so difficult to predict these days. Frankly, I mean, prediction is futile. Nobody would have thought about pandemic or war or anything that we're just facing today. So our mantra is that we need to be prepared rather than predict. As part of the preparation, it is now a process of really going through scenario planning, not just for portfolio, but also operations, which is what the point that Venkat just talked about. Think through the possible different outcomes, think through what are the impact of these outcomes on different asset classes, different sectors, different countries, and then really find or understand whether or not the portfolio will be able to tolerate that different outcome and whether we need to do something that's different. So I think prepare but not predict has become such important principle that help us think about navigating this uncertain future. And finally, I would say diversification. That's like the only free lunch in finance. I think we really need to build a portfolio that is able to diversify across a broad range of outcomes, not just one or two key scenarios. So if you think about resilience, it is really about thinking of the portfolio, not just from a single asset, but really a portfolio of hopefully a well-diversified assets across different types of risk return profile, and that will have resilience across a broad range of market conditions, while still generating, hopefully over the long run, positive real return. I think that has become so important as part of our process. So if you look at the recent experience that we have gone through, we have done a bit of de-risking. I think that is sort of well understood. But in recent years, we have also put a lot more emphasis on real assets, because we think that real assets will play an important role, especially in an environment which is inflationary. And continue to work with our investors to focus on risk reward and understanding of what sort of vulnerabilities they may have in their portfolio, and then really actively manage that risk across different scenarios, like we say, working with the investors. Now, one final point I'd like to share is that we find that it's important to use tools to help us, practical tools to help us build greater resilience in our portfolio construction. So for example, if I again come back to the climate scenarios, we actually partner with some of the external vendors out there to think about possible climate scenarios. And then we incorporate that as part of the stress test and run through our portfolio over different time horizon of different climate scenarios. And at least then we have a starting point to think about what those impact would be under different climate scenarios over different time horizon for different asset classes. And similarly, I think recently our team has also partnered with MSCI to develop an asset allocation framework that really looks at forward-looking macro resilience factors into portfolio construction rather than, like I say, the backward-looking risk measures. And at the same time, trying to preserve the same level of long-run expected returns. Now, if you want to know more about this, you really can check out our website under Think Space for the full report.
That's great. Thank you. That's very, very practical. We appreciate that. We at FCLT, we always try to be very, very practical. So Venkat, let me just turn to you for the final word. As companies and investors consider building resilience, what do you think they should keep in mind? Sumi's talked about data, scenario planning. George has mentioned really just thinking about, how do you respond to disruption? But what would you add here?
Yeah, look, I think that there are 2 or 3 very important points both Sumi and George have made that you need to bring together. Sumi said, be prepared, but realize prediction is futile. So which means you have to think of a number of scenarios, but realize that things could happen that you never thought of. And in fact, they often do. And George said, think about agility, right? And agility is a form of resilience because when that scenario happens that you had not prepared for, the preparations help you. And then on top of that, you've got to improvise, which means you're agile in the moment. Resilience, managing resilience is sort of what in the markets world we would call managing a tail risk, right? It is something that is just not a little bit of a short-term bump, but it's something, an extreme event that you've got to worry about. And I think, so to take their points, which is to be prepared, recognize scenarios may happen that you're not sure for, and then be agile. The final question is, how do you be agile? And I think one of the things I have reflected on a lot, both post-COVID and post-Russia, Ukraine, is we have become a much more digitally enabled society. And many of our younger staff do still think that money moves when you press a button and hit return. It's true sometimes, it's not always true. So one part of resilience is for people to understand how the plumbing works. And sometimes the plumbing is old. And people still send faxes to move money or settle bonds and so on. So it's not always the case, but when it comes down to that, a really important part of understanding resilience is understanding the base operations in the firm. It's not cool, it's not sexy, but it's critical.
That's great. Okay, so the notes that I've made for myself that I'm going to try to do are prepare but don't predict, be agile, make sure we have that agility, and understand the plumbing. So with that, I'm going to thank each of you, George, Venkat, Sumi. Thank you so much for joining us on this webinar. We really appreciate your time and your insight, and this tension between being resilient but being agile, not knowing what's going to come but being ready for whatever comes, I think defines some of and then reacting and having that knowledge of the plumbing and the entrepreneurialism or agility to react when it happens really is going to define the winners and the losers over this turbulent time that we find ourselves in. So thank you very much for your time, and I look forward to seeing you in person soon.
Thank you.
Thank you, Sarah.